I'm Ross Mayfield, investment strategy analyst at Baird, and we're back for another weekly video with Strategas. I'm thrilled to be joined today by Tom Tzitzouris, managing director and head of fixed income strategy at Strategas. And Tom, there's a lot going on right now, so I want to thank you for joining us and then jump right in.
Yeah, my pleasure. Thank you for having me.
Yeah, absolutely. So, you know, the hot inflation print, well, really CPI and then PPI as we're recording this, is getting a lot of attention in markets right now. And after pausing for a bit through April, market-based expectations of inflation have started to move higher. So at the highest level, what are your outlook for inflation and what does that mean for interest rates?
Well, the immediate outlook here is that we have inflation, which is sticky. And what I mean by sticky is we're not likely to see runaway inflation in 2021 or 2022, but more likely, you know, the Fed's historical target has been 2% core inflation. We're more likely to see a 2.5, 2.7, and really sticky around those levels for some time. What that means for bond markets is that very specifically right now, yields do not reflect that. So even though we've seen a push higher and break-even inflations, and it's caught a lot of folks' attention, including the Fed, we still really haven't normalized to even account for potentially a 2.5, 2.7, 3% core inflation. So there's more to go in yields. So that's the short story.
That's great insight. You mentioned the Fed, and I want to then use that to pivot to the other big data point from the last week or so, which was the big payrolls miss on Friday. And, you know, it's no secret that the Fed has been laser focused on employment, really kind of lapping inflation as far as importance to them, or so it would seem. So with the big miss on Friday, you know, how do you view that? I know there were a lot of kind of extraneous factors that went into that report specifically, but how do you think the Fed's viewing that? Does that keep them accommodative for longer? How are you viewing their first move and in the context of that report specifically?
Yeah, I think in terms of the Fed's two primary tools, asset purchases and short rates, it means that they're going to be lower for longer on the short end of the curve. That is, they're going to refrain from any sort of rate hikes, which could disturb the front end of the US Treasury curve. It doesn't necessarily mean that they're going to refrain from tapering asset purchases. That process of tapering very likely still is likely to begin sometime by the late third or early fourth quarter. But that employment report really specifically, what that tells us is that very specifically, the Fed's actions on the front end of the curve are more inclined to damage or weaken the wage outlook for the US economy, the employment outlook, because of the impact it has on the dollar and because of the impact it has on consumer financing. And so they're more likely to hold off from rate hikes. So very specifically, the bond market is pricing in the first rate hikes coming in December 2022. I think the language from the Fed is going to continue to suggest that that is not likely. That is, they're still looking at a 2023 or even late 2023 rate hike. And last week's jobs report further reinforces the Fed's view that the bond market is too soon, pricing in too soon on rate hikes. In terms of asset tapering, though, which is very important for markets such as the Treasury market, mortgage market, housing market, asset purchase tapering is still probably a go later this year. They're just not going to talk about it just yet.
Yeah, I think that's what everybody's waiting for, is for that language and that commentary to shift, because it's going to be subtle, given how often they have to communicate with the rest of us out here. I did want to hit on one thing you mentioned, which was the market expecting rates to hike quicker than maybe the Fed will actually do. There's kind of a history of that, right? There's that famous chart where the market, you know, the expectations are moving higher, and then it takes quite a bit longer for the Fed to actually come off of, you know, for the past decade, it's been zero interest rates, but there's a history of the market being a little bit ahead of the Fed, right?
Yeah, that's very true. The historical pattern might be over the last 40 years, really since Volcker took over at the Fed in the early 80s. The historical pattern there might be that the market prices in tightenings well ahead of the Fed. The Fed is slow to move, but then the Fed eventually plays catch up and then over tightens, even after the bond market says stop, stop, stop. That second part, the stop, 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 has been consistently ignored by the Fed for the last 40 years. So that's a point that I think Jerome Powell, and I know it wasn't exactly your question, but I think it's worth mentioning. Jerome Powell has said in no uncertain terms that he's going to do his best to avoid that stop, stop, stop point where the Fed over tightens. It's a story for a few years from now. But nonetheless, what that means is the Fed very well may be this cycle slow to tighten and actually may under tighten when they eventually do reach their quote unquote peak or terminal Fed funds rate. So that's something to keep an eye on in years 2023 and beyond as well.
That's great insight. Tom, I want to thank you so much for your time today, and we'll look forward to catching up again soon.
My pleasure. Thank you.